We're jumping straight into DigitalBridge today. And, forget the daily volatility you might see on the charts for a second.
Hmm.
Everyone is watching the price action, but the real foundational story here is the massive momentum hidden deep within its specialized fee-related earnings
Right.
and the pivotal high-stakes showdown over the announced SoftBank merger.
This isn't just about watching the stock tick up or down.
No.
It's about decoding a pretty significant corporate turnaround.
The turnaround is right.
Yeah, we're watching a former real estate trust pivot to become, well, an essential global utility provider, basically driven by AI demand. The numbers really bear this out.
So what are we looking at?
Well, to put a point on the scale of this turnaround, the Q3 distributable earnings, they doubled year over year.
Doubled.
And the earnings per share result,
Hmm.
it wasn't just a beat, it was an astonishing 1,100% surprise over what analysts were expecting.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. We synthesize all the noise so you can focus on the critical facts that drive value. I'm glad you're with us.
And we're glad you're here.
If you're enjoying this, make sure to subscribe and hit that like button. It truly helps our work reach more people.
It really does.
And definitely let us know in the comments which company or which stock you want us to simplify next.
So let's lay out the landscape. We have this really powerful bull case that's rooted in operational health,
Right?
and it's colliding directly with a complex bear case that's focused on top-line revenue and, of course, that merger uncertainty.
So for investors looking at DigitalBridge right now, you really have to understand both sides of this equation to make a coherent decision.
You really do.
Okay, let's start with the bull case. Historically, when we look at asset managers, we often focus on the assets they manage. But here, the bullish argument is entirely anchored on profitability metrics. This feels like a different animal than a traditional real estate play.
It is entirely different, and that distinction is, well, it's critical. You have to look past the top-line revenue, which can be noisy, and focus on fee-related earnings, or FRE. This is the financial engine. And we saw those critical Q3 numbers reflecting just massive operational strength. FRE surged 43% year over year to $37 million.
Wow.
And that propelled distributable earnings up 102% year over year, hitting $22 million.
Hold on. For listeners who aren't, steeped in the terminology of alternative asset management, why is FRE the number we should care about? Especially when the company still missed on revenue. I mean, it sounds contradictory.
That's a fantastic question because it gets right to the heart of their business model.
Okay.
Think of DigitalBridge as managing these specialized digital toll roads for the global economy. They earn fees from their limited partners, or LPs, for managing those assets.
And those fees are locked in.
They're locked in through long-term contracts. We're talking typically 10 to 15 years. FRE is that sticky, reliable, recurring revenue stream. It's a lot like a subscription model for a software as a service, or SaaS company.
I see. So it shows consistent profit from their core job.
Exactly. The 43% FRE growth tells us they are not only managing more capital, but doing so far more profitably. It shows stellar cost control and fee capture.
So if the FRE is the predictable subscription-like income, the top-line revenue miss becomes less scary.
Way less scary.
Because that revenue often comes from less predictable sources, like what, one-off asset sales or transaction fees?
Precisely. For an asset manager that's focused on stability, FRE is the true measure of operational health. And that health is supported by just massive scale.
Oh, massive.
We're talking about $108 billion in total infrastructure assets under management.
Right.
And crucially, the fee-earning equity, the money they are actively charging fees on, is $40.7 billion. That's a 19% increase recently.
And they're still raising money.
They're successfully raising capital $4.1 billion year-to-date, with $1.6 billion raised in Q3 alone. And that new capital, it immediately flows into those profitable fee-earning funds.
That brings us to why. Why are institutions handing them billions of dollars? This is where that structural competitive moat comes in, right? Why are these earnings so robust despite the general macro slowdown that's hitting other real estate segments?
It's their pivot.
The pivot into AI infrastructure.
Yes. Their strength comes from being a pure-play alternative asset manager focused purely on essential digital infrastructure. They stopped trying to be a generic landlord years ago.
So now they're all in on...
Today, they're focused on fiber networks, edge computing, specialized data centers, and what they're now calling AI factories.
That term, AI factories, is everywhere in their material, but what does it actually mean physically? How is an AI factory different from the data center I imagine in my head?
It's a generational leap.
Hmm.
A traditional data center handles, general cloud computing or storage. An AI factory is purpose-built to handle massive, sustained computation.
The kind needed by generative AI and large language models.
Exactly. This means specialized infrastructure like liquid cooling systems, because GPUs run incredibly hot, dedicated, high-density rack configurations, specialized power grids.
So they're designing these sites to power the next generation of AI development, not just hosting websites.
That's it. And this level of specialization, coupled with their 30-year track record in digital infrastructure, creates really high switching costs for their LPs.
So their limited partners aren't going to just pull $500 million out of a DigitalBridge fund and give it to some generic private equity fund.
No way. They need this specialized AI knowledge.
So they aren't just building the structure, they're delivering the highly specialized utility needed for the backbone of everything from ChatGPT to specialized military and industrial AI applications. That just locks in their position.
It creates a structural tailwind that, very few competitors can match. They are positioning themselves as an essential utility for global AI computing demands. And that is what sustains the 43% FRE growth.
Okay, that is a very compelling argument for the long-term fundamentals. Now we need the reality check. Let's unpack the concerns, because there are absolutely valid points on the bear side, particularly around that revenue miss.
That's the undeniable reality check. Despite the huge EPS beat, the company did miss on the top line. The Q3 revenue came in at $93.5 million.
Which missed the forecast by about, what, 5–6%?
Missed the $99.16 million forecast by about 5.7%. And look, a miss is never good, but we have to look closely at the reason.
Okay.
Often in a transition like this, revenue might drop because of strategic asset sales or, getting rid of legacy assets that were lower margin or non-core. They are swapping lower margin revenue for higher margin, stickier FRE.
So it's a strategic reduction in revenue for a massive increase in margin and reliability. That makes sense for an asset manager, but the general market doesn't always see it that way right away.
Exactly.
Yeah.
And we can't ignore the external sentiment. The market still processes it as a miss. We've seen some high-profile financial personalities make bearish calls, saying this is not the right stock now.
Which just creates negative headwinds.
It does. However, you have to note that the current price, hovering around $15 a share, seems to have already factored in a lot of these known risks. Investors seem to be looking past the short-term noise to the long-term capital formation story.
This brings us to the biggest short-term catalyst, the one that makes this entire discussion a high-stakes, real-time drama, the SoftBank merger.
Yep.
This is a potential source of immediate upside, but it comes with a major wrinkle that introduces a lot of controversy and speculation.
This is absolutely the single most important short-term item to watch. SoftBank offered a $16 per share all-cash deal.
And when that offer was made, it was a pretty nice premium.
It represented a 15% premium to the stock's closing price on that day. So the standard play here is merger arbitrage, just betting the deal closes at $16.
But the real story isn't the $16 offer, is it? It's the fight over whether the company is worth far more. I mean, they're generating this amazing, rapidly growing, high-margin income from irreplaceable AI assets. Are they selling too cheaply to SoftBank?
That is the core legal and financial tension. Multiple law firms, Johnson Fistel, Halper Seda, they launched immediate fiduciary probes into the transaction.
And what does that mean exactly?
Well, these probes typically represent shareholders who believe the board is potentially undervaluing the company by accepting that $16 offer.
And this isn't just noise.
No, it's fueled by internal estimates and reports suggesting that the real value of their specialized infrastructure portfolio could warrant targets ranging up to $23 per share.
23 versus 16 is a huge gap. What's the legal rationale for that much higher number?
The rationale really hinges on two factors. First, the growth rate. A 43% growth rate in their core metric, FRE, that implies a much higher multiple than this $16 offer reflects.
And the second factor?
The specialized nature of the assets. Since they are the backbone for AI, these assets are just incredibly strategic. So law firms are arguing that if the board ran a full public auction, the strategic value of those AI factories would drive the price closer to that $23 mark.
So this pressure creates the speculation. Either SoftBank is forced to raise its bid, say to $18 or $19?
Or the deal breaks down entirely. And then the stock is left to trade purely on those fundamentals we just discussed.
So the stock is currently trading not just on the strength of its AI fundamentals, but primarily on the likelihood of a merger close, and whether that closing price will be $16 or maybe higher because of this ongoing controversy.
Exactly. And what stands out to me, looking at the institutional flows, is the belief from the big money. Institutions are overwhelmingly convinced about this business model and its value proposition.
The numbers are staggering. We see 92.69% institutional ownership. That kind of concentration suggests sophisticated investors are locked in for a reason.
It does.
But doesn't having such a high concentration pose a liquidity risk if one or two major funds decide to unwind their positions rapidly?
It absolutely introduces concentration risk. That's a very fair point. However, the fact that these sophisticated players are still aggressively adding to their positions suggests they're betting the upside potential outweighs that short-term liquidity concern.
What does that look like?
We're seeing cluster buying, Davenport & Co., for instance, adding over 200,000 shares, a 15.4% increase. Azora Capital initiated a new position worth almost $24 million. When capital is flowing in at that pace, it signals conviction in the core value.
And if we look at the general market consensus right now, that conviction translates into a price signal that actually sits above the immediate merger offer.
It does. The average consensus target points towards $17.69 per share. That suggests the street believes there is more value to be captured than the initial $16 SoftBank offer.
Whether that value is realized through the fiduciary probes leading to a revised bid,
or through the continued spectacular growth of the standalone business if the deal collapses, they are pricing in a premium to the current offer.
So what does this all mean for you? DigitalBridge is sitting at one of the most fascinating crossroads we've seen in the market lately. You have the rock-solid foundational strength, the surging 43% fee-related earnings, and the indispensable AI infrastructure tailwinds.
Right.
But the short-term drama is all about the merger dynamics and this fight over valuation.
It's a highly tactical situation where you have this evidence of financial health coinciding with a major corporate action. The question for any investor watching this is, well, how do you prioritize those two forces in your portfolio?
The question you should be mulling is this. Is this stock primarily a short-term merger arbitrage play for you? Meaning you are betting on the $16 deal closing quickly, or maybe even a revised, slightly higher bid fueled by these undervaluation probes. That's a low-risk, defined return thesis.
A pretty straightforward play.
Or should you treat it as a multi-year hold, banking on the spectacular 43% FRE growth and AI infrastructure dominance, and view the SoftBank deal as merely a potentially low ceiling on a much larger opportunity? That distinction arbitrage versus long-term asset management defines your time horizon and your risk tolerance completely.
It's a compelling situation where the fundamentals provide a powerful safety net, but the merger provides a speculative ceiling that is currently being challenged.
That's the lowdown on DigitalBridge for today. If you haven't already, subscribed so you don't miss our next breakdown. We'll catch you on the next one.